Hello, I'm Donald Leggett, and welcome to the latest London South East CEO interview. I'm joined today by Andrew Prelea, CEO at Vast Resources. Vast have recently started mining and producing copper concentrate in Romania, and also have a diamond concession in Zimbabwe. Hello, Andrew, and thank you for joining us today.
Hi, Donald. Thank you for having me.
Are you coming to us from Romania today?
Yes, I am. I'm sitting in our office in Bucharest. So, yeah, downtown Bucharest.
Fantastic. You must be thrilled to have got Baita Plai, the Romanian polymetallic mine, into production. It's been a tricky 2020 for you.
It has indeed. I mean, putting into perspective, we've managed from funding, which happened at 31st of January to 22nd of October is when we announced the actual copper concentrate production. We started mining earlier than that, underground, preparing for concentrate. But in 9 months, we managed to reopen the mine and get it into production. And it's a credit to the team on the ground.
It is indeed a credit to the team. It's evolved a number of placings since the start of 2020. Are you through the worst of all your difficult times now, do you think, Andrew?
Oh, definitely. Well, now that we've got production, that means income generation. We've raised enough money to get the mine open in time to meet our commitments. And I'm confident now that we're over the worst of it. And now hopefully it's all uphill or downhill from here, should I say, not uphill.
If you could take us through the offtake agreement with Mercuria, has the first production actually been delivered, and when can you start receiving payments on that production?
Well, the first production, we started the production in middle of October. We had some other stock ready to go together with that production. So we met our targets for October. We're waiting for the vessel to be announced by Mercuria for the offtake. We were told it will be in the early November. We've got the quantity ready. It's already packed and ready to go. We're waiting for the containers to arrive on site, and we anticipate that will be during the course of next week. What day exactly, we're waiting for the vessel confirmation, but we are ready to ship, and literally it's a one-day truck drive from the mine to the port, and once we deliver to port, we get paid within 24 hours. So first payment, first sale will be during the course of next week. That
will be a very big moment in your life.
Well, I mean, we've got the asset sitting on the ground and it's already pre-sold technically, so the commitment is there. It's just, it would be nice to have the cash in the bank.
Indeed. What do production estimates look like to the end of 2021? Are things looking pretty good?
Well, production estimate, I mean, we met our target for October. We're confident we're going to meet our target for November. In fact, we're very confident of that, and December. Then we'll have a ramp-up phase during the first quarter of next year, which will take towards doubling production by April, May. I think in our RNS in September, 7th of September, we said July as a conservative estimate, and we'll stick to that officially. And all of that, including what we call the decline development, which is going into the next level down. That will take us to about $9 million of free cash at the asset level in 2021, including the last quarter of this year, and that ramping up to about $14.5 million at current commodity prices. Actually, they're modeled on slightly lower commodity prices for 2022, 23. So we've given a 24-month forecast, and over the course of the next few months, we'll probably be delivering a PFS externally driven, but that's not a priority for the company right now. The priority is to actually get into production and bring cash in the business.
Yeah, you previously mentioned hot commissioning of the flotation plant and a second stream. Now, in simple terms, what are the benefits of this? And do you need to do the second stream to hit your targets going forwards?
For the targets for next year, we need to get the second line operational. At the moment, we've got the first line that was refurbished, which is producing the copper concentrate. We're also doing a zinc concentrate at the moment, which is not producing, let's say, the quality is good, but not commercial quantities. That will not happen until about December, which was always part of the plan. Mm-hmm. The second line will let us run the second mill, which will then allow us to double the quantities for both the copper and the zinc. And then earlier next year, we'll start to float the molybdenum as well, which will bring us a fourth income stream out of the mine.
And in terms of financing, where are you with the asset-backed debt financing, which you've been discussing recently?
Well, we've been in negotiation with the institution since March this year, and it is a tier one bank. We've gone through all the due diligence. They've done all their site visits, not only technical, but occupational health and safety, environmental, and all the other wonderful things that come across with institutional finance. well, it's not just institutional, they're banking finance, should I say. And we're anticipating, we've been advised that we'll get a binding term sheet by the end of November. They'll do their final credit committee approval in December, and we're looking forward to drawing down on that facility, which will allow us to take out the balance of the current facility with Atlas and move forward, which is an asset-backed debt.
Okay. And moving from level 18 down to level 19, is level 19 going to be what's going to provide you with ore for the next 3 to 4 years life that's left of the mine?
We've got, I would say, 6 to 9 months in the current level, which is where we're mining now. And
18?
18. It's 17, 18. It's in between. Where we have open stopes, it's a bit oxidized, so there's a lot of safety issues that are addressed as we're doing. That's why we put in low targets for the first few months. While we get into the fresh ore, we mine out the older open stopes. And what we also need to add to a comment is that in the JORC that we produced last week with that 608,000 tonnes of measured, indicated and inferred, that's not including about 135,000 tonnes in 1718 because we only drilled down, we didn't drill across. So there's an additional 135,000 tonnes, which is not even in the JORC, in any of the JORC figures that we gave, which is the area that we're mining now.
Will that increased JORC mean that the mine life is fairly easily extended beyond 3-4 years?
Well, the mine life as it stands today is already at about 11 and a half years with what we've got. It could take it to 20, 25 years, or we can increase the production rate by starting up the second mill and the second line, which we plan on doing next year. But we've also got an installed capacity for double that. So we've got in place a third mill and a plinth for a fourth mill. The problem is the bottleneck in the haulage, and that is a restriction of 16,000 tonnes a month in haulage from the underground above. And there are several options to overcome that, which we can't do until we get to level 20 if we want to do a raise bore and convey it up. The other alternative is to use an XRT and crush and pre-dilute underground with an XRT. And the third option, which is probably the most viable option, and we're doing the feasibility on that right now, is to use the existing infrastructure and shafts and do a double-decker cage, which will require new motors and new hauling equipment on top of the existing, because the most expensive part of shafts is the actual infrastructure of the shaft itself, and the peripherals such as the engine and hoisting gear that could potentially be upgraded, and we're getting quotes on that right now to see if we can ramp up production during the course of next year and potentially double production on top of the figures that have already been announced to the market.
Okay, let's take you from Romania to Zimbabwe. What's happening with the JV for the Chiadzwa community diamond concession? There's some kind of a delay there. I'm sorry, I'm not very familiar with it.
No,
tell us all.
Last October, we were in a position where we were advised, and the minister at the time had called a press conference with Reuters and Bloomberg and all the local press that we would be signing within the next week. It was actually meant to be 2 days after that interview. Unfortunately, we know what happened, but we can't discuss it. But internally, there was an issue with the community, and that got delayed. They went to Russia. They told us we'll sign when they get back. Unfortunately, it couldn't be done. The issue wasn't resolved. They managed to sort the community issues out, and that was about March this year. And then COVID hit and everything had stopped. So we're still confident we're proceeding with that. We understand the asset. We understand what we have to do. We know the area. We know the ground. We know what it's capable of. And we're hoping that once everything settles down, that we'll be able to proceed. Let's watch this space. It's probably the best way of putting it.
And to proceed, you mean to proceed, but is it drill ready?
They're all alluvials, so it'll be basically alluvials, gravels mining between 5 and 25 metres deep. So it's quite an easy setup. It's a small footprint. It's a 150 tonne an hour XRT machine that will be on site, which will be a hands-off system from the screens all the way through to the sort box. So what kind of revenues could you expect from a diamond concession like that, of that size and quality? If you look at the historical grades in the area, of anywhere between 30 and 60 carats per 100 tonnes. That's pre-screened. And on the screening, you get anywhere between 2.5 and 5 times. So you could get anywhere between 125 and 250 carats per 100 tonnes, going through 150 tonne an hour XRT. That's in the vicinity of about 190 carats 190,000 carats per month at an average price of anywhere between 65 and now they're getting $100 a carat. So the revenue stream is anywhere, between $9 and $14 million a month.
And that's net revenues?
That's net revenues. And then after that, you've got your costs and your distributions. It could be anywhere between $3 and $7 million a month in free cash to the company, all depending on the grade and the sales price in the markets at the time.
Oh yeah, so quite a substantial contribution then.
It is, and also it's a contribution. It's a community-based project. With the community, we're getting quite a bit of the profits distribution, and also the government, the ZCDC, will be getting a considerable amount of profits on top of their royalties. It is a joint venture with the community and the government. And we're doing it in such a way that it will not be a sanctioned entity like some of the other industry within Zimbabwe.
Okay, I'm intrigued to see that Mark Mabudu has gone back to being in charge of the Zimbabwe government's diamond agency. He was previously in charge of it. He worked with you. Now he's back to being in charge of the diamond agency. Is that a good or a bad thing for Vast? I mean, Mark is clearly embedded in the politics of Zimbabwe.
Actually, no, it's quite to the contrary. The reason why he didn't retain his job at the ZCDC is because he wasn't embedded in the politics. And the reason why he was chosen now is because he's not embedded in the politics. It was to create a proper industry, and he's already achieved quite a lot in the first 6 weeks in the seat. We are very confident that it's not only good for Vast, but it's also good for the diamond industry as a whole in Zimbabwe. There were all potential conflict of interests were declared when he took on the job. We've also made it public that he's welcome to come back to Vast when he finishes his mandate there. His mandate is to improve the diamond sector in Zimbabwe, and part of that mandate is to sign joint ventures with companies such as ourselves and others that are interested in participating. And we believe it's a benefit for everybody, not just Vast, for him moving back into the
indeed, he seems very experienced and very sensible.
Which is why we employed him in the first place.
That makes sense. Okay, finally, last question. It's been a long haul for shareholders. So why should investors put their money into Vast? It probably is a good point to be putting the money into right now, I would have thought. So what's your answer to that? Why now?
Why now? Because the asset alone of Baita, which is now in production, we've got 50 years of mining history. Actually, it's got over 1,000 years of mining history, but 50 years under, say, modern mechanized mining. We know what's in the ground. We know what we can produce. We're producing exactly as we thought we would, even though it's in the startup phase. And the valuation of the business is a fraction of the value of our one asset. And we have several assets in the portfolio. It's producing, it's income generating, and unlike most mines, and I say this with a bit of a smirk, not many mines can say that they are operationally profitable after the first 2 months of production.
Andrew Prelea, that was fascinating. Thank you so much for joining us from Romania today. For more interviews like this one, please subscribe to the London South East YouTube channel. There's lots of interesting video content up there. Just look for the tab at the top of the homepage, the video tab at the top of the homepage. Thank you very much for watching, and do stay safe.